Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about ALLISON Transmission Holdings INC quarterly report. Allison Transmission Holdings Inc. offers a diverse range of businesses and services, including designing, manufacturing, and selling fully automatic transmissions for commercial vehicles, providing electrified propulsion systems worldwide, offering transmissions for various applications such as plus distribution trucks, plus refuse trucks, plus construction equipment, plus defense vehicles, wheeled and tracked, selling branded replacement parts and support equipment, remanufacturing transmissions under the Raytran brand name, providing engineering services, extended transmission coverage, and defense kits to original equipment manufacturers, distributors, and the U.S. government. The decline in Allison Transmission Holdings Inc.'s stock price over the past year can be attributed to several key factors. The company's disappointing third-quarter earnings and reduced full-year guidance have raised concerns among investors. The significant weakness in North America on-highway segment due to lower demand for Class 8 vocational and medium-duty trucks has also contributed to the decline. Furthermore, the $2.7 billion acquisition of Dana's off-highway business, while strategic, has increased leverage and led to a projected lowering of EBITDA margins. Additionally, Allison Transmission's reliance on internal combustion transmissions and slower progress in electrification efforts have exposed the company to declining revenue and heightened competitive threats amidst industry transitions towards alternative propulsion systems. These factors collectively have resulted in a 20.96% drop in the stock price over the past year, with the stock reaching a new 52-week low of $76.85 on October 30, 2025. The primary drivers of revenue growth or decline can be identified through an analysis of the financial summary provided. On one hand, revenue growth is driven by increased demand from certain end markets such as defense, plus 47%, North America on-highway, plus 28%, and outside North America on-highway, plus 11%. Additionally, increases in liability, warranty issued during period, and deferred revenue have also contributed to revenue growth. On the other hand, revenue decline is primarily driven by a decrease in net sales, minus $131 million, accounts receivable, minus $31 million, and lower demand from various sectors such as energy, mining, and construction outside of North America. Specifically, the North America on-highway end market experienced a significant decline due to lower demand for Class 8 vocational and medium-duty trucks. Overall, the revenue growth or decline is largely influenced by fluctuations in demand across different end markets and sectors. Net income and profit margins decline. A summary: the company's net income has experienced a significant decline over the past year. For the 9 months ended September 30, 2025, net income decreased by 6% from $556 million to $524 million. This trend is even more pronounced in the 3-month period, where net income plummeted by 31% from $200 million to $137 million. Profit margins have also taken a hit, with gross profit margin decreasing from 48.1% in 2024 to 47.6% in 2025. Operating income margin has followed suit, dropping from 31.5% in 2024 to 29.4% in 2025. The reasons behind this decline are multifaceted and not explicitly stated by the company. However, it is possible that various legal actions and administrative proceedings have contributed to the decrease. Additionally, a non-recurring settlement charge of $4 million in 2024 may have had an impact on net income. The One Big Beautiful Bill Act, OBBBA, has also affected taxable income and effective tax rates, further exacerbating the decline in profit margins. The company's financial performance indicates a consistent generation of positive operating cash flow. According to the provided data, the company generated $593 million and $590 million in operating cash flows for 2025 and 2024 respectively. This trend suggests that the company has been able to manage its operations efficiently, resulting in a steady stream of positive cash inflows from its core business activities. The company's debt level and interest expenses have undergone significant changes over the past year. Initially, the debt level increased significantly due to an acquisition, rising by $2,732 million, page 33. However, this was partially offset by a slight decrease in long-term debt from $2,414 million to $2,4 $410 million, page 21. Despite these fluctuations, the total debt level has increased from not specified for December 31, 2024 to $2,510 million as of September 30, 2025, page 43. In terms of interest expenses, there is a mixed picture. While interest expense decreased slightly for both periods, page 3, it also decreased by -13% and 1% in different time frames, pages 39 and 42. Overall, the company's debt level has increased significantly due to the acquisition, while interest expenses have shown some fluctuations but generally remained stable or decreased. Management is optimistic about the company's outlook, citing a strong short-term position with $1,236 million in authorized repurchases and sufficient liquidity to fund operations for the next 12 months. In the long term, the company plans to acquire Dana's off-highway business using cash on hand and debt, while expecting decreased net sales in North America, but offset by price increases. The company is also executing growth initiatives in the defense end market and has successfully continued these efforts. Financially, management may seek to retire senior notes through various means, including cash purchases or exchanges for equity securities, and plans to replace the bridge facility with permanent financing prior to closing the acquisition. However, there are risks associated with expansion outside North America, particularly from currency exchange rate changes. Overall, management's strategy focuses on growth through acquisitions and initiatives while managing financial risk. The company's financial summary reveals that it has engaged in both dividend payments and share buybacks. Specifically, the company confirmed paying dividends of $164 million as of September 30, 2025, indicating a commitment to returning value to its shareholders. Additionally, multiple pages detail the company's share repurchase program, demonstrating a strategy to reduce outstanding shares and boost earnings per share. Concerns about inventory buildup and supply chain disruption. The company's financial summary highlights potential issues with inventory buildup and supply chain disruption. Notably, a significant increase in purchased parts and raw materials by $13 million suggests that the company may be stockpiling materials, which could lead to inventory buildup. Furthermore, the document mentions increases in costs due to disruptions or shortages of labor, freight, raw materials, energy, or components used for manufacturing or transportation. This indicates potential supply chain issues that could impact production and delivery of products. Additionally, the regulatory review of the acquisition has disrupted the supply chain, adding another layer of concern about potential delays or shortages. These factors collectively suggest that the company may face challenges in managing its inventory and supply chain, which could have significant implications for its operations and profitability. That concludes the financial summary for ALLISON Transmission Holdings INC. Feel free to comment below, and I will be happy to answer them when possible.